Welcome back to Portfolio, everyone. And in this video, we're going over 7 stocks you should take a look at this week. On this list, we have a combination of high growth stocks, some stable dividend payers, and we actually have 2 speculative stocks on this list today. So every single Sunday, we go over stocks you should keep your eye on for the upcoming trading week. All these companies have some big news headlines coming out, earnings reports, or some other big news events that will likely lead to some volatility with the share price, which could make some nice buying opportunities. So we do this every single Sunday, and this week we have 7 different companies from various sectors of the market that all operate and produce income doing various different activities, and we're going to go over each and every company, do a quick overview of why they should be taken a look at this week, and just go over each and every company to determine which ones we may buy over the next coming days. So thank you for tuning in. I am the Gen Z investor, and every single day we talk about different stocks you can buy. We go over overall stock market performance, and we go over any other big stock market news and headlines. So we're going to jump right into it. And the first stock on this list today is, of course, Tesla. They've been making so many news headlines as of late. They were actually not included in the S&P 500. The new revamped S&P 500 was released later last week, and Tesla was not included. So it actually led to a large decline in share price. You can see here in after hours trading, shares have dropped over 6.4%. And if we take a look at the last week of trading, shares were down over 5%. And at one point, Tesla shares were down 23% from their high. So they have been on a rapid decline as of late. So now might be the opportunity to jump in and buy. And when the market opens this next upcoming week, if this post-market trading continues and we see a steeper decline, Tesla may be a company you want to take a look at during this dip. Of course, this company has been on a roll, up over 847% over the past 12 months. This week, after this latest news release that they are not part of the S&P 500, is really going to help shake up this price and may lead to a lot of volatility moving forward, which of course could create beautiful buying opportunities for this company. Current market cap at $389 billion. And on the 52-week range, you can see here, not directly at that all-time high anymore because we've seen about a 20% reduction from the high. So very interesting company to keep an eye on this week. That big news headline coming out late last week that they were not included in the S&P has really led to a sharp decline in aftermarket value for the company. Stock number 2 is another growth stock so far, and this company reports earnings this upcoming week, which is why we have to keep an eye on them. Peloton, ticker symbol PTON. So of course they distribute and sell like various exercise equipment, and they offer kind of a premium product and service as well as the actual physical equipment and the actual piece that you order to your home. They have like different video and monthly subscription services as well that you can buy into their fitness and exercise plans. So this company is a newly IPO'd company, and year to date the stock has shot up 183%, which is absolutely incredible. Slight decline from their 52-week high, and if you take a look at the past couple of days, peak at around $91 a share, all the way down to $80. So as the overall market declined, like we saw at the end of last week, Peloton saw a sharp decline as well. So this is an interesting week for the company. They're reporting their earnings, and why I want to keep my eye on Peloton this week is because they're actually releasing some cheaper exercise equipment. So their products are a premium product. They do charge a high price tag for each of their goods, but now they're actually going to announce it's expected that this week they're going to come out with cheaper stay-at-home equipment. So it's actually going to be a reduction around 25% in cost, where they're going to come out a cheaper treadmill and a cheaper high-end stationary bike, slashing the existing price of their already on the market bike. And of course, their new tread will actually cost less than $3,000 compared to their current models, which run around $4,300. So it's going to be very interesting to see this announcement of a cheaper, more affordable exercise machine. And I'm sure they're doing this because they understand people are staying at home. Gyms are still closed in some parts of the United States, and people are uncomfortable going out to work out in a large public space. So of course, this stock has benefited great because they operate and they sell stay-at-home workout machinery. And that is exactly why their share price has seen a rapid surge. And a price target has actually been increased for the company over the next year. A JP Morgan analyst sees a price tag around $105 a share by 2021. So currently being valued at $80 a share, a lot of potential upside if it was able to reach this price target. Stock number 3 to keep an eye on this week is a very stable dividend paying stock. So we have on this list, we have a combination of growth, dividend payers, and some speculative plays at the end, but we have to go over some stability. During this time of very low bond interest rates and overall market interest rates, where the Fed has a rate close to zero, it's kind of very hard right now to get some attractive yield, some attractive cash flow coming into portfolios. So investors are really seeking some nice consistent dividend income from companies yielding over 2%. So Johnson & Johnson, the dividend king, ticker symbol JNJ, a long, stable company, a very strong hold in many people's portfolios, is currently yielding 2.7%. And if we take a look at the past month, if we can get Johnson & Johnson during a dip like we've seen over the past few days, it may be a great time to jump in. So the stock has seen a decline, same as the overall market, and if the market continues to go into the red this upcoming week, Johnson & Johnson is a company I will have my eye on. Like I mentioned, we like to add dividend income to our portfolios during red days, and this is a company where I'm very comfortable holding them for the next 10 plus years. Over the past 10 years, they're up over 152% with just share price appreciation. If you look at this beautiful long-term chart, long, consistent upward trend year over year. And of course, that doesn't even include their nice 2.7% dividend yield. And if we take a look at that dividend, current yield at 2.72%, very, very, very sustainable payout ratio of 51% of earnings. And they did a nice job of growing that dividend at an average rate of over 6% over the past 5 years. And if we take a look at their dividend safety score, currently ranked 99 and extremely safe, the highest dividend safety rating possible, a company where it's almost impossible for them to cut that dividend anytime soon. Stock number 4 on our list today is another growth company, a smaller cap company with a market cap at only around $47 billion. And of course, that is a large company overall, but compared to the beast we just took a look at of Johnson & Johnson with a market cap of close to $400 billion, smaller in comparison, but relative to other companies, still massive. Ticker symbol LULU, Lululemon, currently valued around $361 a share. Rapid share price appreciation up 100% over the past 12 months. Absolutely incredible. This is another company that is reporting earnings this week. And if you take a look over the past 5 days, like again, we've seen the overall market decline and Lululemon saw a sharp decline as well. And this is a company where there's a lot of strong future outlook moving forward for them. If we take a look at their income statement, they've done a beautiful, beautiful job of growing revenue year over year, consistent upward trend every single year. And that is actually followed by net income. Each and every year, overall upward trend in net income. Over the past 5 years, nice upward line of net income growing year over year. So that's exactly what you want from this growth company. They've seen a massive run up, and if this week continues to go red, and they are actually reporting their latest earnings is in this upcoming week, if we can see some red and we can take a look at their earnings, this is another company I'm going to have my eye on. I like their brand. They have very strong brand loyalty. They actually sell, once again, a premium type athletic wear product. And people who invest and actually purchase their goods love the quality and they become very loyal to the brand that for a lot of different individuals out there, Lululemon is always their go-to. So another company that reports earnings that's going to be at the top of my watch list, and I may add to a portfolio if we see a nice dip during a red day or if we see some strong positive outlook because of their earnings. Next stock on our list, the final more stable company. The final 2 stocks on our list are more speculative plays. Stock number 5 is Etsy. Etsy is a company I've been watching very strongly as of late. This company has been performing very well. They just got added to the S&P 500. So during last week's revamp of the S&P, 3 companies were added. Of course, 3 companies were removed. Tesla was not added to the index, which of course we saw that sharp decline. Etsy was added to the S&P. And you can see here in after hours trading, that's led to a jump of 5.7% for their shares. On the 1-year chart of 123%, which is absolutely incredible to even think about, up 123%. Over the past 5 days, they did see a decline, which is, of course, like we've mentioned with all of these companies, was kind of led by an overall market decline over the past 2 days. But this company has seen rapid growth over the past year. If we take a look at their income statement once again, this company has been growing their overall business at a rapid rate. They are an online marketplace for people to sell more unique and creative or personalized goods, and I believe that market is only going to continue to grow. I believe now that we're spending more time buying gifts online, and I really think Etsy is going to thrive this holiday season because now we're not going to have crowded superstores, supermarkets before holidays. Malls are not going to be jam-packed like they've been throughout all of recent history. Before Christmas and every different holiday, malls are jam-packed with people side by side, squeezing in to try to buy last-minute gifts and presents. Now, with the global pandemic and social distancing, I really do not think that's going to happen. I really believe people are going to be spending a majority of their time buying online and ordering a lot of goods from online retailers. So I think Etsy is actually going to thrive because of they're more designed towards personal, unique gifts. That's a big part of their online marketplace. And I think during this holiday season, with the more shift to online digital purchases, Etsy is going to continue to grow quarter over quarter and year over year. And this company is profitable, posting growing profit over the past 3 to 4 years, which is perfect to see. So another company, a new member of the S&P 500 that I have my eye on this week that I may start a new position in. The final 2 companies this week are much more speculative plays. The first 5 are more stable businesses that we kind of expect them to see grow year over year. The last 2, a little more up in the air. The first one is DraftKings. Both of these companies that we're going to talk about next are more gambling type companies. The first one is DraftKings, and the second one is Penn National Gaming. And why we have to talk about them this week is because the NFL is back. The National Football League, one of the largest sports leagues in the entire world, is coming back, and they start this upcoming week. The sports gambling world is only growing as new states are allowing and making it legal to legally bet on sports games. Now that entire industry is growing, and we're seeing a lot of gambling companies grow as well. If we take a look at DraftKings, up 12% over the past month, the fresh young IPO company, $9 a share a year ago, steady upward climb, rapid share price growth over the past few months, trading around $37 a share. If we take a look at Penn National Gaming, up 183% over the past year, and of course you can see from the March lows, they have only surged. Up 100% in the past 6 months, $4 a share during March lows, up to $54 a share. Take a look at that. $4 a share at March lows, steady upward climb quarter over quarter, month over month, and it's absolutely crazy to see that Penn is now trading at $54 a share. So now with the NFL coming back, I think both of these companies are going to see some growth. I think the overall sports betting industry is going to grow rapidly over the upcoming years, especially with the advancement in the technology, but of course the also expansion in growth. A very young, innovative industry is of esports, but now these companies are working toward a way to actually expand gambling into esports. So this gambling world continues to grow. These are 2 companies where I personally will not invest in them. For me, they do not fit my criteria to be an investable company just yet. I like dividend-paying growth companies that are stable and actually have consistent cash flows coming in year over year. These companies are too young for me. Of course, many people love these companies and they believe they are the future. So we're talking about them this week because of the restart of the NFL. NFL kicks off later this week, and I think these companies may see a surge once the sports betting world gets back into it. Once I said, NFL is one of the largest sports in the United States, if not the largest, and I think gambling will come with that. People already love to gamble on sports, and now if they have a legal way to do that, sitting from their cell phone at home, I think these companies are going to benefit very well. So those are 2 other companies to keep your eye on. Like I mentioned, very more high-risk speculative plays. DraftKings, Penn National Gaming, high risk. You could say high reward, but of course, when you say high risk, high reward, the high risk is guaranteed, the high reward is not. So always keep that in mind when taking a look at these companies. Those were 7 different stocks I'm keeping my eye on this week. Thank you for tuning in, and I will see you in tomorrow's video.